On guys, session we have topics that's been asked by the UPSC repeatedly again and again. That's called a base rate. And if we look at the components of money and banking out there, one of the most major impacts in base rate and carried out by MCLR. What's a base rate, sir? So, sir, when we talk about the base rate, it's a minimum rate at which bank lends. As you know that the major component of a banking function is that it lends money out there. It earns interest. That's its major function, major business out there. That's how it runs it. But sir, when we talk about base rate, it's a minimum rate at which scheduled commercial banks are allowed to lend. And it's been directed by RBI as well. Directed by RBI as well. How this lending rate is decided completely depends upon the operational cost of bank. Completely depends upon the operational cost of bank. How is it decided? Let's see. For example, if this is B1, this is B1 bank out there. If this is B1, and if the lending rate is, say, suppose 6.5% out there, how the 6.5% is decided? That's the question. This 6.5% depends upon a lot of factors. For example, the first would be out there is repo rate. First would be out there is repo rate, sir. Is repo rate. Another will be the deposit rate out there. Another will be the deposit rate. As you know, sir, lending rates always be higher as compared to deposit rate. For example, if a bank is taking a loan or opening a saving accounts there for 5%, it's going to lend at 7%. That's for sure, because it's going to recover its cost at 5%. So if it's taking money at 5%, it's going to lend at 7% out there. So repo rate and deposit rate. These are certain factors. These are certain factors. Another factor, of course, bank runs, there has been an operation cost as well. In order to recover the operation cost, in order to recover its operation costs out there. In order to cover its operation cost out there. Then, of course, because it is giving loan, it will get loan after some time. There has been a duration in which bank will not get anything. That's called premium weight, because it's going to get its return or interest or principal amount after some point of time, not immediately. That itself involves a lot of risk. What, say, for example, if bank lends someone a lot of money out there? What if bank lends someone a lot of money out there, but a person defaults by saying, let's say, it doesn't pay interest and principal amount within 90 days out there, sir? That's called non-performing assets, and it will create a twin balance sheet problem out there. That will affect. It's a risky business. As I said in my earlier class as well, that banking is actually a very risky business out there, because you never know what's going to happen. Remember 2008 financial crisis out there. That's a subprime crisis that's been taking place out there. It's a very risky business out there. You need to remember that. So of course, bank needs to consider that tenor premium. Tenor, I'm calling that interest and principal amount. Tenor premium. Tenor premium. So that's how thing works. These are the, I would say, a major factors that determines lending rate out there. That determines lending rate. Now, let me come to another point. It's called a base rate. Base rate. What's base rate? What's base rate? Sir, rate below which banks can't lend. Rate below which banks can't lend out there. That's been directed by RBI under RBI Act 1934. Rate below which banks can't lend out there. Banks can't lend. Banks can't. That's simple as simple. Base rate. That's a base rate that's been decided. Now, so you need to know how repo rate, how transmission rate, or how repo rate leads to transmission in this. For example, if I say, I would just give a brief over this. If repo rate is less, it means bank will get a lot of money, getting credit from RBI at lower rate of interest. It will lend more. Lower repo rate involves higher lending. And of course, if that's simple demand and supply, if a bank has a lot of money out there, deposit lending rate will be higher. Lending means there is lower lending cost, there is lower lending rate, there is lower lending rate, there is lower lending rate. Trust me, question has directly asked for this, directly been asked why repo rate is not able to lead to a transmission rate. I mean, if you reduce down the repo rate, simple as that, banks gonna lend more. When banks gonna lend more, what happen? It will have an ample amount of surplus with it. It will gonna lend more out there. It will gonna lend more out there. What will happen? At lower rate of interest, because there is ample amount of money out there. So, but if repo rate is higher, if repo rate is higher, reduce lending, because banks not gonna buy at higher rate of interest. Reduce lending. There will be shortage of money with the banks. It will lead to increase in lending rate. That's simple. We have discussed this previously. Let's understand one more thing. Is this repo rate getting transmitted into a lower lending rate? It has to. By concept of economics, this has to follow. This has to follow by the concept of economics out there. But this is not happening in the market. This is not happening in the market. Lower repo rate is not getting transmitted, or it's not getting, I would say, applicable, leads to a lower lending rate out there. It's not leading to a lower lending rate. What's the problem? The problem itself is a ACLR. ACLR. Average cost of lending. Now, what's this? We have to discuss. This is transmission system. This is transmission, which has failed. As per the economic concept. If repo rate is less, banks gonna buy more. Banks gonna take more loan from RBI. There would be ample amount of resources, ample amount of liquidity with bank. They're gonna lend more, because there is ample amount of liquid with them. There will be less lending rate. Lending rate will be lower as per the average. But this is not happening. Lower repo rate doesn't leading to a lower lending out there. What's the issue? Let me give you an issue. Let me briefly explain you. That's the concept we are going to study. That's called MCLR and ACLR. Marginal cost of lending rate, average cost of lending. Just understand this whole diagram out there. You'll get to know what it is. Okay. Suppose this is a bank. The bank out there. The B1. It received it receives three deposits. That's 50,000 deposit at 7%, 75,000 deposit at 8%, 1 lakh of deposit, 9%. It receives percent. Deposit account, one at 7%, at 8%, at 9%. Assume things that repo rate is 5%. Repo rate is 5%. Now at repo rate 2024, this is 23. So as per this, the average cost for bank, the deposit rate would be 789. That's 8%. Average deposit cost for bank. Average deposit cost for bank is 7 plus 8 plus 9 divided by 3. 17, 7, 24, 8. That is 8%. This will be an average cost for deposit. This will be an average cost. Just understand, just bear with me for certain time. You'll get to understand this concept holistically out there. You'll get that. Average cost of deposit for a bank is 8%. So just tell me, if the average cost of bank is 8%, will it lend at more than 8% in the market or less than 8%? Will it lend for more than 8% or less than 8%? answer involves that it's more than 8%. That's total complete, I would say it's a common sense out there. Because if the average cost is 8%, it's gonna lend at more than 8%. It's gonna lend at more than 8%. It's gonna lend at more than 8% of. Okay, sir. That's how thing works. That's how thing works. And sir, for example, you need to understand that deposit rate and lending rate depends upon the repo rate. If repo rate is lower, lending rate will be, I would say, will be lower side. Will be on a lower side because there will be ample amount of resource with them. Lower repo rate, lower lending rate, lower deposit rate. Higher repo rate, less amount with banks, it will lead to higher lending rate and higher deposit rate. Now in this, average cost for bank is 8% and it's gonna lend more than 8%. Okay, got it. In 2025, repo rate changes. Repo rate changes. Say for example, repo rate increases to 7%. Repo rate increases 7%. What's gonna happen, sir? What's gonna happen? It at 7%. It would be, I would say, okay, let me give you an example for this. Make it easier for you. Make it easier. Reduce this. Repo rate is 4%. Bank makes repo rate at 4%. This means ample amount with the bank. It's gonna lend more. It's gonna lend at more at lower rate of interest. At lower rate of interest. Possibly it will reduce down to less than 8%. If bank is, for example, at this moment at 2024 is lending at 9%, now due to repo rate has been fall, it will going to lend at lesser percent because it's got ample amount of liquidity with it. It's gonna lend at, suppose, say for example, 7%. It will make sense because now repo rate has been fallen, lending rate would fall down to 7%. That's absolutely fine. That's a common sense out there. But sir, this is not going to happen. This is not going to happen. Because there has been a fault. There has been a fault. Fault in transmission lines. Fault in transmission rates. How? Fault in transmission. How, sir? Why there is a fault in a transmission? Why there is a fault in a transmission? So let me tell you one thing very. Let me tell you one thing very clearly. Repo rate has fallen to 4%. Now the bank's gonna lend at 7% out there, not at 9%. Gonna send it 7%. But sir, it's still bearing the cost of its previous deposits. It's still bearing the cost of its previous deposit. It has to pay 7% to this 50,000. It has to pay 8% to this 75,000. It has to pay 9% to this 1 lakh amount. Again, the average cost for bank is still 8%. It's still 8%. It's still 8%. Would this lend at 7%? If the average cost is still coming at 8%, would they lend at 7%? No, it's a complete business failure out there. So that's the reason. Not happening. The transmission rate is not happening because the average deposit had still been the same. But to revive this, to improve on this method, we have come up with MCLR method. MCLR method. That's an improvement over previous base rate. That's marginal cost of lending rate. That's marginal cost of lending rate. Marginal cost of lending. To understand this, what has been improved with this, we have introduced MCLR. So if in 2025 this banks receive deposit of again 70,000 at, say for example, percent, at for example 6. Now sir, still the average cost is still 8%. It's gonna lend and more. Average cost is still coming 8%. But we're gonna ignore this. Because RBI what it introduced MCLR, marginal cost of lending rate. it's gonna be decided based on this deposit, not these deposits. It's gonna be decided on the basis of these deposits, not these. So if now bank has to define its lending rate, it's gonna take this value 6%. It's gonna take this value 6%. So if the deposit rate is 6%, it can lend at 6.5%. Can lend at 6.5%. Now there has been repo rate has been fall, repo rate has been fall. Now lending rate has been again fall down because there has ample amount. This is leading to the transmission. This is transmission. And I'm going to explain this in a very brief out there because that's very important subject component out there. And it's absolutely fine if you don't understand this, but this is how you think. Okay. Suppose bank fund was there, 50,000 at 7%, 75 at 8, 1 lakh at 9%. Average deposit cost for bank. Bank is paying interest at 8%. Of course, if bank is paying 8%, it's gonna lend at more than 8%. As simple as that. That's a basic sense out there. So suppose bank is lending at 9%. Bank is lending at 9%. Now, repo rate has fallen down to 4% in 2025. If repo rate falls down, this means bank's gonna borrow more from RBI. It has ample amount of liquidity out there. It's gonna lend more, but at lower rate of interest. Absolutely, because supply has been increased, money has been increased. But sir, this is not happening because again the average cost of bank is coming at 8%. It has to pay interest to this amount. But improve on this, we have come up with MCLR method, marginal cost of lending rate. For example, in 2025, if bank receives 70,000 at the rate of 6%, we're gonna ignore this. We're gonna ignore this and just look at 6%. Okay, deposit cost is 6%. Now what? Based on operational cost, based on deposit cost, based on tenor premium, we're gonna decide that lending cost will be 6.5%. Now, with fall in repo rate, the lending rate has also been fall. That's called a better transmission as compared to previous base rate out there. That's called a better transmission as compared to the previous base rate out there. I hope you got this concept clear. Clear? If you have any doubt, you can ask about this session. I'll more than happy to clear that thing. That's how thing works. That's how thing works. This MCLR is also called, this MCLR is also called an anchor rate. An anchor rate. Called an anchor. MCLR also called an ample rate out there. Ample rate out there. Now what? Now, okay, we decided that, okay. This is called, when I talk about MCLR, this is nothing but internal benchmarking that's been asked by UPSC. It's an internal benchmarking. Internal benchmarking. But there is another thing called external benchmarking. There is another thing called external benchmarking. But there is another thing called external benchmarking. What's that? External benchmarking. What's this? What's this? Okay. See, there is different method to lending. There is a different method where lending can be improved. So what are these lending method out there? Trust me. Just listen to this. You'll get this. RBI says, okay. RBI gives another alternative to bank to decide their lending rate. For example, RBI says, okay, fix your lending rate based on certain parameters. Fix your lending rate based on repo rate, based on treasury yield. Forget about treasury yield as of such now. Repo rate. For example, if repo rate is 4%, fix your lending rate based on this. Forget about the internal benchmarking MCLR. Just look at this. Repo rate is 4%. You're gonna lend. What will be the lending rate? What will be the lending rate out there? What will be the lending rate out there? Lending rate out there. It will be repo rate. Repo rate plus, say for example, certain percentage, 3%. So repo rate is 4% plus 3% plus 3% gonna be 7%. Gonna be 7% out there. This repo rate, obviously, it's subject to change. It's a volatile. It's gonna be changed as RBI changes its repo rate out there. But what is this 3%? What is this 3%? What is this 3%? Saying to you. repo rate plus 3. So this is called spread. This is called spread in money and banking. This is called spread. And it is decided by bank, individual bank, based upon its deposit cost, based upon, of course, its operational cost out there, based upon the salaries that it's been paying to its employees out there. All this stuff is taken into account by bank to decide this spread. So spread is decided by bank based on its balance sheet, based on its balance sheet, based on its balance sheet. Based on its balance sheet. I hope you got this point. I hope you got this point. So it is called internal benchmarking. This is called internal benchmarking. Why it's called internal benchmarking? Because bank has been decided based on their own individual cost out there. They are deciding the spread. Repo rate, again, it's going to be volatile. It's going to be decided by RBI out there. That's called internal benchmarking. And RBI has mandated the banks out there to use internal benchmarking or external benchmarking while deciding their lending cost, while deciding in lending. They has mandated, it's been compulsory for the banks to use these methods of internal benchmarking and external benchmarking out there. Again, it's for compulsory for the banks. It's not compulsory for the NBFCs, that non-banking financial companies out there. So banks has to maintain this. And again, sir, it's been improving because the transmission line or transmission rate has been lower. Now it's growing appropriately, because now if you reduce on the repo rate, lending rate will come down. Lending rate will come down. Earlier, this was not the case. As long as quickly we introduced the MCLR method out there, improvement upon the base rate, it's improved out there and it's been taking quite nicely. Economic Survey 21-22 also says that there has been a better transmission rate as compared to the previous years out there. So I hope you got these concepts of internal benchmarking and external benchmarking. I just want to explain this. Again, I have a PPT. I do want to explain that over that as well. But trust me, if you need to understand, just visit to this chart. You're gonna help. It's gonna help you. It's gonna help you a lot, because that's where all things lie. That's where all things lie, sir. Let me go to the PPT out there. Let me go to the PPT out there. So from internal to external, India's lending rate. India's journey. Okay. So the base rate, it was 2016. Again, standardized minimum lending rate for bank. But sir, but there was a poor transmission. That's the whole issue. And a mains question has been asked, why there? What's the major reason for the poor transmission? You need to explain all these stuff in the main as well, and it's going to help you in the prelim, because this has been repeatedly asked by the UPSC over and over again, I hope you got this. Poor transmission was the ultimate option, was the ultimate issue that's been facing by banks. Out there. I hope you got this. Okay. On the base rate issue, slow rate cuts, bank discretion, limited transparency, all these issues were there. But these are certain. If you don't ever get a point out there, what's the issue with the banks? Just say slow rate cuts, bank discretion, limited transparency. That's a basic point out there. You can use these points in any of your answers in any of these subjects based on the circumstances out there in the mains examination. Now, sir, this MCLR that's been introduced after base rate, an improvement over the base rate, and an improvement over the base rate is been 2016 to 2019. It replaced what's more responsive lending rates. Apply to all new floating rates. Again, we have explained that what's some marginal cost of lending. It technically excludes the average cost of deposit. It takes into account the newer deposit, as the case in the I've explained in the chart as well. Because in 2025, it has received a 70,000 of deposits at 6%. Now this 6% gonna be help us to decide what the lending rate, not the previous one, the average cost of deposit, which was coming out at 8%. I hope you got this point. Okay. All these marginal cost of funds. Again, the newer rate at which bank receives in 2025 called the marginal cost of fund. Okay. Called the marginal cost of. Tenor premium, additional charge based on residual maturity. Again, tenor premium, what's the meaning? Because bank's going to lend some to you. The maturity period will be around 2 years or 3 years. In between, it will get EMIs on interest on that. But again, for that 3 years, it's a cost. For example, if you're going to construct your house, more time it will take, the additional cost it will hit. That's called overhead cost. In economics and accountancy, it's called overhead cost, indirect cost. You inculcate based on a time period. So in order to recover that, of course, this factor will be taken into account while deciding the lending rate out there. Then again, sir, operating cost. Bank is a physical space out there. A lot of employees work over there. There has been operation cost, technology cost, all these stuff. It will be accounted for that. It will be accounted for that. Okay. Now, again, the tenor premium. What's MCLR? Better rate transmission. Of course, it's leading to the better transmission out there. Because now, if you reduce the repo rate, you get a plenty of amount with bank, because bank's gonna borrow at large from the RBI. Once it got the plenty of amount with it, the lending rate will fall. That's a simple supply out there. More the supply of the case, lower is the lending rate. That's a simple demand and supply economics concept out there. I hope you got this again, because I've explained this concept in a holistic manner out there, a brief, by drawing all sort of charts out there. I hope you got these. Again, see, when I say what's PPT, PPT is just to remind you that, okay, we have studied this. It's for a fast revision. But if you want to understand certain topic from a depth point of view, not on a shallow platform, or you want to get into a depth, or you want to understand what's going on with this issue, you're gonna take, just revisit the lecture out there. Just revisit the lecture. Just think about that. Use your brain out there. Don't be a passive recipient out there, just listening and doing nothing and making notes out of there. No, economy is not that subject. Even you have to do that, do it for environment and history out there. Just use your brain, use your common sense. Get to learn a lot from this. That's a very interesting subject out there. It doesn't involve any sort of memorization. It doesn't involve. That's one classic benefit of this exam or subject. And that's again external benchmarking and internal benchmarking out there. Internal benchmarking, what MCLR? External benchmarking, when you take into account repo rate plus spread out there. That's called external benchmarking. Spread again is based on bank's operational cost or cost out there. It depends upon the bank to bank. Varies account that. But repo rate, again, it's a variable factor out there. It's going to change as RBI changes it, repo rate will change. And it's an external benchmarking out there. And RBI has mandated that bank has to consider MCLR or external benchmarking or internal benchmarking while deciding the lending rate out there. It's a compulsory for them. For scheduled commercial banks, again, remember that it's a compulsory for them, not for NBFCs, Okay. So I hope you got all of these concepts. If you ever want to revisit this again, ever want to understand that, just replay this video, and come to this slide. You'll understand all of the stuff. I hope you got this. That's enough for the day, because it's gonna take time to digest. It's not a very easy concept out there. I hope you got this. Okay, thanks.